You log into your brokerage account, and the screen is a terrifying sea of red. Decades of hard-earned savings seem to be evaporating in real time before your eyes, triggering a primal, almost undeniable instinct to hit the sell button before everything vanishes completely. This visceral reaction to stock market crashes is a universal human experience, yet it is precisely this moment of absolute panic that separates generational wealth builders from those who permanently lock in their devastating financial losses. The greatest and most persistent myth in investing is that market crashes are unpredictable anomalies that ruin financial futures without warning. In reality, significant downturns are a historical certainty, acting as a built-in feature of the global economic machine rather than a catastrophic glitch in the system. By understanding the underlying mechanics of these sharp drops, we can transform periods of intense fear into the most lucrative, wealth-accelerating opportunities of our entire investing lifetimes. Today, we are opening the definitive playbook on market resilience, meticulously dissecting the anatomy of financial collapses to build a robust strategy that withstands the chaos. The core play is shifting our mindset from reactive, emotional survival to proactive, data-driven positioning. We will explore how smart investors navigate the storm, not by attempting the impossible task of timing the market, but by mastering their own psychological responses and deploying capital with calculated, surgical precision. To truly master the downturn, we must first dissect the specific trigger points that send global exchanges into a sudden, terrifying tailspin. A crash rarely happens in a vacuum. It is typically the explosive result of prolonged economic imbalances colliding with a sudden, unexpected catalyst. Whether it is a rapid spike in central bank interest rates, a geopolitical shock, or the collapse of an over-leveraged sector, the underlying fuel is almost always a rapid shift in liquidity, which simply means how easily assets can be bought or sold without drastically affecting their market price. When this crucial liquidity suddenly dries up, sheer panic becomes the dominant currency on the trading floor. Institutional, algorithmic trading programs and retail day traders alike rush for the narrow exit simultaneously, creating a vicious, cascading effect where falling prices trigger automatic sell orders, pushing valuations down even further. This phenomenon introduces extreme volatility, a financial term describing the rapid, violent, and highly unpredictable price swings that define a market in deep distress. Navigating this extreme volatility requires recognizing that the stock market is essentially a giant emotional pendulum, swinging wildly between irrational exuberance and unjustified despair. During a severe crash, asset prices often detach completely from the actual, fundamental value of the underlying corporate businesses. This profound detachment is where the absolute greatest danger lies for the unprepared novice. But it is exactly where the disciplined, strategic investor routinely finds their most significant long-term advantage. We can see this pendulum swing clearly by examining the late 1990s, a chaotic period defined by the spectacular rise and devastating fall of the dot-com bubble. Eager investors poured billions of dollars into unproven internet startups with zero profits, driven by the dangerous belief that traditional valuation metrics no longer applied in this new digital economy. The broader market was completely intoxicated by the revolutionary promise of the internet, dangerously ignoring the fundamental laws of business sustainability. When the speculative euphoria finally broke in early 2000, the resulting crash wiped out trillions of dollars in paper wealth and erased countless overvalued companies from existence entirely. Yet, the crucial lasting lesson from the dot-com bubble is not just about the inherent danger of excessive, unchecked speculation. It is about the quiet survival of fundamentally sound businesses that were unfairly dragged down in the blind panic, eventually recovering to completely dominate the global economy over the next 2 decades. The lingering echoes of that historical tech collapse remind us that a great technological revolution does not automatically guarantee a great, immediate investment return. Smart investors eventually learn to separate the underlying, world-changing innovation from the temporary speculative frenzy, recognizing that buying assets at any price is a guaranteed recipe for disaster. This deep historical perspective serves as our very first, most vital line of defense against falling victim to future market bubbles. Less than a decade later, the global financial system faced an entirely different, far more dangerous beast with the 2008 financial crisis. This was not a localized, speculative bubble in a single sector, but a massive systemic failure built on a crumbling foundation of complex, high-risk mortgage products. Major banks had essentially woven a web of debt so incredibly tangled that the sudden collapse of the American housing market threatened to bring down the entire global banking infrastructure. As the terrifying reality of the 2008 financial crisis unfolded, global credit markets completely froze, healthy businesses could not secure basic funding, and the devastating impact spilled rapidly from Wall Street directly to Main Street. The sheer terror of this systemic freeze sent the stock market plunging over 50% from its previous peak. For the average individual, this genuinely felt like the end of the modern financial system, prompting many to tragically liquidate their retirement accounts at the exact bottom of the market. However, those who bravely held their ground and maintained their positions during the 2008 financial crisis eventually participated in one of the longest and most robust bull markets in recorded history. The subsequent powerful recovery demonstrated a profound truth about the ultimate resilience of the global economic engine. Human ingenuity, relentless corporate adaptation, and massive central bank interventions eventually restored market stability, richly rewarding those who maintained a disciplined, long-term perspective. Understanding these monumental historical events brings us to the single most critical variable in any market crash, which is raw investor sentiment. The fascinating field of behavioral finance shows us that human beings are hardwired to feel the psychological pain of a financial loss roughly twice as intensely as the joy of an equivalent financial gain. This deeply ingrained psychological bias, known as loss aversion, is the invisible hand that routinely forces intelligent people to make highly irrational decisions during a downturn. When the daily news cycle is completely dominated by catastrophic headlines and predictions of endless economic doom, a dangerous herd mentality quickly takes over the public consciousness. We instinctively look to the frantic actions of others to validate our own choices, assuming that if everyone else is aggressively selling, they must surely know something terrible that we do not. This collective panic creates a disastrous self-fulfilling prophecy, driving asset prices down to levels that defy all logical, mathematical valuation. To successfully break free from this destructive herd mentality, we must proactively build a framework that removes human emotion from the equation entirely. A truly resilient strategy is carefully constructed long before the storm clouds gather, utilizing specific data-backed plays that automate our essential financial decisions. By establishing strict, unyielding rules for our capital deployment, we prevent our primal survival instincts from sabotaging our long-term wealth accumulation when the pressure is highest. The absolute foundation of this resilient strategy is proper asset allocation, which is the strategic practice of dividing your investment portfolio among different, non-correlated asset categories, such as domestic stocks, international equities, and government bonds. Your specific personal allocation should be carefully dictated by your current age, your long-term financial goals, and your individual tolerance for portfolio risk. This structural foundation ensures that a severe, unexpected drop in one specific sector does not obliterate your entire net worth overnight. Closely tied to this foundational concept is the vital principle of diversification, the proven strategy of spreading your investments across various distinct industries, geographic regions, and company sizes to drastically reduce your exposure to any single point of failure. If you own fractional shares in 50 different companies across 10 different economic sectors, a catastrophic business failure in one specific company becomes a minor, temporary speed bump rather than a fatal portfolio crash. Diversification remains the only true free lunch in the investing world. The financial fortress we carefully build through these methodical practices is not designed to completely avoid all losses during a major crash, because achieving that is mathematically impossible without entirely sacrificing your growth potential. Instead, it is specifically designed to minimize the painful depth of the drawdown and significantly accelerate your eventual recovery timeline. When the broader market inevitably fractures, a properly allocated and diversified portfolio acts as a heavy-duty shock absorber for your accumulated wealth. One of the most efficient and cost-effective tools for achieving this necessary broad exposure is through ETFs, or exchange-traded funds, which are pooled investment funds that trade on public stock exchanges and typically track a specific broad market index. By simply purchasing a single share of a total market ETF, you instantly acquire fractional ownership in hundreds or even thousands of the world's most profitable established companies. This completely eliminates the profound, unnecessary risk of trying to pick individual winning stocks. With broad, diversified market exposure firmly established, the next crucial play is implementing the mechanical strategy of dollar-cost averaging. This disciplined approach involves investing a fixed, predetermined amount of money at regular, scheduled intervals, regardless of whether the broader market is currently soaring to new highs or plunging to terrifying lows. When asset prices are high, your fixed contribution naturally buys fewer shares, but when the market crashes, that exact same contribution automatically scoops up significantly more shares at a steep, attractive discount. This relentless, automated process of dollar-cost averaging effectively turns terrifying market volatility directly to your long-term advantage. It completely removes the highly stressful and historically futile attempt to perfectly time the absolute market bottom, a task that even seasoned professionals rarely achieve. By continuously and blindly buying through the darkest days of the downturn, you systematically lower the average cost per share of your entire portfolio, positioning yourself for truly explosive growth the exact moment the economic tide finally turns. As we steadily accumulate these heavily discounted shares over time, we harness the unparalleled, almost magical power of compound interest, the mathematical process where the returns on your original investments begin generating their own additional returns over time. This compounding effect is relatively slow and unnoticeable in the early years, but over several decades, it creates a massive, unstoppable snowball of generational wealth. A severe market crash is simply a rare, golden opportunity to pack substantially more snow onto that ball at absolute bargain prices. While navigating these visible market drops, we must also fiercely guard against the silent wealth destroyer known as inflation, which is the gradual, relentless increase in the price of everyday goods and services that slowly erodes the actual purchasing power of your cash over time. Keeping all your money hidden in a basic savings account out of a paralyzing fear of a market crash practically guarantees a massive loss of purchasing power over a lifetime. Investing in productive, growing assets is the only historically reliable way to outpace this invisible, compounding tax. To ensure these powerful concepts are applied correctly, it is highly recommended to consult with a fiduciary financial advisor, a licensed professional who is legally obligated to act strictly in your best financial interest, to tailor these strategies to your specific, unique situation. Every individual investor has highly unique tax considerations, specific retirement timelines, and varying future income needs. A qualified fiduciary can help you rigorously stress test your portfolio against historical crashes, ensuring your customized strategy aligns perfectly with your ultimate life goals. Stock market crashes will always remain a deeply terrifying prospect for the uneducated and the unprepared, but they absolutely do not have to dictate your ultimate financial destiny. By deeply understanding the historical causes, actively managing your own psychological reactions, and relentlessly executing a disciplined, highly diversified strategy, you can successfully navigate any future economic storm. Remember that all investing involves inherent risk, and past performance does not guarantee future results. But with the right, proven playbook, you can decisively transform moments of global market panic into the unshakable foundation of your lasting financial legacy.